Hi there. Today we'll explain hidden bank reporting obligations, what financial privacy really means in the UK, and why understanding the 2026 rules matters.
Tax authorities do not monitor your income through a single, unified system. They operate through a stark asymmetry: highly advanced automated algorithms for one type of data and outdated manual reporting for another. We are Pro-Tax Accountant, a specialized UK accounting firm navigating the complex intersection of advanced tax compliance and wealth planning for business owners. Consider the standard operating structure for a modern UK limited company director. You draw a highly tax-efficient, low base salary. You extract the bulk of your profits through a high dividend yield. Simultaneously, you hold joint personal savings accounts generating interest alongside your spouse or partner. A dangerous assumption exists within this structure. Directors routinely operate as if HMRC's systems monitor their salary, their savings interest, and their company dividends with the exact same level of automated precision. That assumption is factually incorrect. Relying on it is currently triggering massive automated penalties across the United Kingdom. Treating all income as equally visible to the tax authority blinds you to the specific blind spots in your compliance. You have to understand the asymmetry to see exactly where the algorithm is waiting for you to make a mistake. The root of this compliance trap lies in the severe asymmetry built into UK bank data sharing laws. His Majesty's Revenue and Customs operates a $4.6 billion analytical supercomputer called Connect. This system maintains total automated visibility over your bank account interest. Domestic private dividends, however, sit in a completely different category. They remain a total algorithmic blind spot. HMRC relies exclusively on the taxpayers' manual self-assessment declarations to track them. This split system is codified in law. Finance Act updates recently formalized and accelerated automated bulk data collection for financial institutions, locking in the asymmetry. The immediate threat arrives with the 2026 to 2027 tax year. The tax-free dividend allowance has been slashed to a historic low of just £500. This vastly increases the statistical likelihood of a reporting omission for anyone extracting company profits. Exceeding that £500 allowance, even marginally, provides the precise trigger point the system uses to initiate a formal compliance inquiry. Schedule 23 of the Finance Act 2011 and its 2026 updates provide the legal architecture for this surveillance. It legally mandates UK retail banks and building societies to submit Bank and Building Society Interest, or BBSI, returns directly to the state. In practice, banks no longer wait for individual compliance notices. They automatically extract, validate, and push exact customer interest data to HMRC via a standardized recurring XML schema. This automation becomes highly complex when applied to joint accounts. The Income Tax Act 2007 provides strict statutory rules for how this interest is attributed to individual taxpayers. If you hold a joint account with a spouse or civil partner, the Connect system processes the bank's data feed and automatically assumes a strict 50-50 split of the interest income for tax purposes. For unmarried cohabiting couples, the 50-50 presumption does not legally apply. Tax liability follows the actual beneficial entitlement of the deposited funds. If you contributed 80% of the capital, you owe tax on 80% of the interest. UK banks now act as automated reporting arms for HMRC. By the time you receive your annual interest statement, the same figures have already been mapped to your tax account. To understand how HMRC uses that bank data, you have to look at the architecture of the Connect system. Connect operates by linking seemingly disconnected domestic and international databases to your single national insurance and taxpayer ID. First, Connect pulls vehicle ownership and financing data directly from the driver and vehicle licensing agency. Next, it ingests property purchase records, historical valuations, and ownership structures straight from the land registry. It maps your active corporate directorships, shareholdings, and company filing histories through deep integration with Companies House. The system cross-references over 55 billion individual data items against your officially declared income. It calculates the minimum required capital to maintain your specific assets, flagging lifestyle discrepancies in a matter of minutes. Connect calculates a baseline of your expected expenditure based on these assets. If your declared income cannot support the upkeep of those assets, the system identifies the inconsistency automatically. This brings us to the structural anomaly. Foreign dividends are caught and reported automatically under international common reporting standard treaties. However, domestic dividends extracted from a UK private company are not automatically reported to HMRC. There is no third-party data feed for your private company payouts. The entire compliance burden rests on your manual self-assessment, specifically the SA 102 form. This chart visualizes the brutal financial math taking effect. The dividend allowance plunges to £500. Simultaneously, the tax rates climb, pushing the basic rate to 10.75% and the upper rate to 35.75%. Furthermore, the Finance Act updates introduce a strict SA 102 rule for close company disclosures. Failing to check the required disclosure box triggers a fixed £60 penalty. That £60 penalty applies for a simple formatting omission, and it is levied before HMRC even begins to calculate the actual tax owed on the undeclared dividend capital. Professional compliance requires precise documentation. Directors must maintain contemporaneous board minutes and formal dividend vouchers. If you lack this paperwork during an inquiry, HMRC has the authority to reclassify those dividends as salary, subjecting them to severe income tax and national insurance rates. If Connect logs a high consumption lifestyle through your property and vehicle records, but your manual dividend reporting shows a suspiciously low extraction rate, the algorithm will instantly flag your file for a formal compliance check. When an anomaly is flagged, HMRC determines your penalty based on a behavioral assessment. They legally categorize your failure to declare income as either careless or deliberate. This table breaks down the penalty structure. Note the severe contrast in the minimum penalty floors. Finding your own mistake and declaring it is an unprompted disclosure, which can carry a penalty as low as 0%. Waiting for HMRC to find the error is a prompted disclosure, where the penalty floor jumps significantly. Consider a director who misses an £18,000 dividend declaration due to carelessness. If they correct it proactively, the penalty can be mitigated to 0. If they wait, the exact same error carries a mandatory minimum penalty of 15% of the tax owed. The mechanism HMRC uses to initiate this process is the nudge letter. Receiving this automated prompt officially reclassifies your case. You lose the right to make an unprompted disclosure, and that 15% minimum floor is permanently locked in. Ignoring the data asymmetry and waiting for the algorithm to generate a letter guarantees a significantly higher, entirely avoidable financial fine. You cannot hide in the data. The Connect system already possesses your exact interest returns. It is simply waiting for your manual dividend declaration to align with your algorithmic lifestyle footprint. The only effective strategy is proactive correction. Reconcile your manual SA 102 filings before the system forces a compliance check. Please note, this video is for educational purposes only and does not constitute formal tax or legal advice, as UK tax laws change frequently. If you are a UK business owner or director, do not wait for a nudge letter to arrive. Contact Pro Tax Accountant today to implement bespoke, resilient tax planning. Reach our team by phone at 07985 689 912, via email at info@protaxaccountant.co.uk, or visit our website at www.protaxaccountant.co.uk. Subscribe to the Pro Tax Accountant YouTube channel to ensure you stay ahead of all future statutory changes and HMRC algorithmic updates. Take control of your manual reporting before HMRC's automated algorithms take control of your finances.